Many people think that not having all their eggs in one basket is having multiple advisors, when that's really not the case. It's being diversified amongst investments in the stock market. One advisor is selling something, the other advisor is buying something, and they do it within that 30 days. And now you're getting hit with tax when one person thinks they're helping you, the other person thinks they're helping you. The realization is you're actually being hurt.
All right, another episode. You ready, Robert?
I'm good. I'm ready. It's Friday.
Okay. So today's going to be a little bit different. A lot of times we have topics we really dive into. But today we wanted to go over four common questions we get. And then, of course, we'll do our mailbag. So you want to kick us off with the first question?
I will. And I always think this is a fun one when people ask it because they always want to know how much risk should I take. So I guess that's the question to you, because we all want very little risk and high reward. Like, I want to make everything the market makes, but I never want to lose money. So answer that question. How much risk should a person take?
That's a tough question to kind of, it's an important question.
30 seconds. Go. Yeah. You got to answer all of it.
You want to know your time horizon, your risk tolerance, and what your goals are, first of all. And what I mean by that is, let's say somebody's really comfortable with risk, right? They want higher returns and are comfortable with a ton of risk. You might think, well, that means hands down they should have a portfolio, say, in 100% stocks. And that may or may not be true. It depends on what the goals are, right? Mm-hmm. If it's for retirement, that might make sense. If let's say you're a very aggressive investor, but you have a portion of that money you need for your taxes, your property taxes next year, or you need it for a down payment for a business or a home, those are parts of the portfolio that you're going to want to consider in something that it's less volatile. Because the last thing you want is to invest part of your portfolio for a goal 18 months from now. 18 months has come. You need to pay that kid's college. You need to buy that car with cash or whatever the case may be. And now that investment you had is worth 20% less because the market's down. So
but you could have different buckets, right? I mean, that's kind of what you're saying.
Yep.
Different buckets.
And that's exactly what you want to do. You're leading me there. You want to have a bucket for your short-term investments, a bucket for mid-term investments, and long-term. And again, for an investor, even if they're aggressive, part of their assets can be invested at different risk tolerance levels, and I think that's huge. To line up how much risk you're taking with when you need that liquidity.
Well, and I guess the next question that we commonly get, and it's kind of loaded, just going into the different buckets. So I know what your answer is going to be. So I'm curious how you're going to break it down. Is given those different buckets, what's a reasonable expectation for a return to expect when you're working with an advisor or doing it on your own?
So it's going to depend on how the portfolio is invested. Right.
Yeah.
But let's dive into that further. If you're looking at equities, historically 10 to 12% is what's reasonable. On the fixed income meaning CDs, bonds, whether it's government or treasuries, you're going to be more to 3 to 5% right now. 10-year treasuries around 4.5%. So that's very realistic to make about 4.5% with very, very little risk. And most people have a blend of a part of their portfolio in fixed income, meaning bonds, and a blend of equities, of stocks. The more stocks you have, over time, you should make more money, but it's going to be more volatile. We've talked about that in the past. On the price of admission, if you want that return closer to 10 to 12%, is you got to put up with volatility in the account. Now, one thing too I think is important is a lot of times people assume that age is the main thing that dictates how much you should have in stocks and bonds. Not necessarily. As you know, we had one of our oldest clients who's passed away not too long ago, was 101 years old. Yep. Yeah. And you remember the conversations we used to have with her, and we've shared this story with others, where we had a 101-year-old lady, beautiful lady, who had
She was a sweetheart.
virtually 99.9% of her money in stocks.
Mm-hmm.
And sometimes people would think, well, when they hear that, that doesn't make sense. Why would you have somebody at that age in this much in equities? Well, what were her goals? Obviously, we knew she was already retired. She was not going to live to 1,000, but her goals were to make as much money as possible for her kids and her grandkids when she passed away.
And now great-grandkids.
Yep.
They're still generations with us.
Yep. And on a side note, for those of you who aren't aware, when she passed away, most of her money was in a brokerage, taxable, as opposed to tax deferred, as opposed to a 401k or an IRA. So when she passed away, her kids, her grandkids, they get a stepped up cost basis, which is huge. Sorry to go off in the weeds on that.
No, I want you to, this is completely off topic, but if you're going to talk about this individual client that was with us for more than a decade and was such a wonderful lady, you have to tell your favorite part about her when I would go meet with her.
Well, there's a few things. So,
it's off topic, but it's a good story.
There's
She's
a
sweet.
few things. So I remember what I think you're referring to is one of the thing I make fun of, give you a hard time on is when we would go to her house, right? I think that's what you're talking about.
Yeah.
Several times we went to her house. She was extremely with it mentally. She was hard of hearing.
That's it.
And when sometimes you would say something she couldn't hear, she'd hit you with a cane. Right?
Tell me to speak up.
And then I would pretend like I can't understand him either. Like Robert's not talking loud. I don't know what he's saying either. Robert, why are you whispering? And then she'd hit you under a table with a cane.
Constantly picking on my southern accent. Okay, so let's play off of her real quick. So I know we've had this conversation with her, and there's reasons why we didn't sell certain things with capital gains, so that they did get the stepped up cost basis. But there are many conversations we have with people where they want to know, should they invest in individual stocks, mutual funds, ETFs? And that's a common conversation we have on a weekly basis. Yeah. So what's your answer to that on what somebody should invest in? Or if stocks, mutual funds, or ETFs are right for them?
Yeah, so the main investments out there typically, I mean, of course, you could argue you could do private equity and hedge funds and alternatives. Having done this for 22 years, I think it is now, my experience has been at those bigger firms where they have these private equities, these alternatives. Typically, they're pushed just because of the embedded fees, the commissions, right? But when you take a step back and look at the performance, they underperform the market. Mm-hmm. So I'm a little biased most of the time against those alternatives, private equities, hedge funds. There are some that do amazing, but in general, the ones that an average client's going to have access to, they're not the best out there. So moving on beyond that, what can you invest in? You got your equities, meaning individual stocks. You got your ETFs. You got your mutual funds. I suppose annuities, although 99% of the time I don't think those make sense. So let's talk about mutual funds, ETFs, and individual stocks. Mutual funds can make sense. I would say if you had $100,000, you just want to do it yourself, a mutual fund is probably going to do a pretty good job. And again, you got to do your research on what mutual fund are you in. Are you in stocks, bonds? Make sure the embedded fee is reasonable. But that could do a decent job. The only hang up on a mutual fund is as your investments grow, you're going to most likely be paying a little bit too much in there embedded. You're going to have taxes that are going to be passed on to you, right? Because the mutual fund inside, they're turning over the account, even though you may not have.
Well, and I don't know if you want to dig into that. I know what you mean, but that could be confusing to somebody else that doesn't know what you mean. What do you mean when I can invest in a mutual fund, but pay taxes even though I haven't made any money, or even if the market may have been down and maybe I lost money?
Yeah.
You want to touch on that?
Sure. So basically, I'm invested in a mutual fund. Mm-hmm. Market comes down dramatically. I don't sell, but the guy next to me or lady next to me does sell. That incurring a capital gain within the mutual fund. You know, now pro rata that trickles down to me because they could have had an embedded stock that they sold that had a low cost basis. So now there's a significant capital gain. So you, in theory, this doesn't happen every day of the week, but it happens. You, in theory, could own a mutual fund, lose money, and then pay taxes as if you make money. So That's an issue in my mind with mutual funds. Another one would be liquidity, entering or exiting it. Let's say it's 10 a.m. and you want to get in a investment. If it's a mutual fund, 10 a.m. Central, that order doesn't execute or take place until the end of the day, 3 p.m. Central, right? So anything that's happened throughout that day, you missed out.
Right. And that happens more often than I think people think.
Absolutely.
And even the fact of paying taxes when you've lost money, you said it doesn't happen that often, and it really doesn't. But over the last 16 years, including 2008, that's happened a handful of times, a couple of times. And it kind of shocks people when they realize that that's a possibility.
Typically, the bigger the mutual fund, the longer it's been in existence, those are the ones that happens because their cost basis tends to be lower, right? And I don't want to name particular mutual funds, but there's a half a dozen out there I could rattle off that if the market comes down, you're going to lose money. Again, you would have no matter where you invested because that means the market's down, but you're going to pay capital gains. That part was avoidable. Perhaps it's not avoidable to lose money, but it is avoidable to pay a capital gain when you just lost.
Well, and I know you said if you don't really know what you're doing or you want to do it yourself, do a mutual fund. And I know a very common thing because one of the biggest options you have in somebody's 401k is a target date fund.
Yeah.
And so people tend to do those target date funds when they retire. You got any thoughts on target date funds?
Target date funds are a double-edged sword. A lot of 401ks now, they're becoming more and more sophisticated. More people out there have the options of picking their own investments, or there's, 100 options, and you can pick some ETFs that you want. Some mutual funds, even in this day and age, they might have 6, 7 options, and they're target date funds. For those of you who aren't familiar with what that means you pick a date, so 2030 or 2035, when you want to retire. And as you age, as you get closer to that time, the account's going to become more and more conservative. Why? Because in theory, once you retire, you're going to need more income, so you don't want your portfolio to be so volatile, right? The problem with that, I would argue, is the target dates to a certain extent don't really have a brain on them, meaning the market could deteriorate, and what might we be doing? Again, there's always case by case, so I don't want to generalize too much, but if the market's coming down, typically we do our best to be greedy when others are fearful when others are greedy. A la, Warren Buffett. Yeah. So what that means is if the market's down, we're going to look for opportunities. Yeah. There's a ton of stocks we've talked about in the past, whether it's CrowdStrike, who had a blimp on the radar last year due to Delta Airlines, right? It hurt the Delta Airlines traffic control, so it hurt the stock too of CrowdStrike, and it came down dramatically. That we thought was an opportunity. Sure enough, now it's doubled in price. So you want to take advantage of when the market's fearful, whether it's fearful on the whole market in general or a particular stock. Well, what is a target date fund going to do in theory? Let's say the market's deteriorated. We're buying, trying to take advantage of that. The target date fund might say, okay, Robert, now you're, how old are you, 52? Now you're 52.
You wish.
Now you're a year older and you're closer to your retirement date of whatever that target date fund is, 2030, 2040, whatever it is. So because you're 1 year closer to retirement because of the target date fund you selected, it is making you more conservative at the precise moment that theoretically we might be making that client more aggressive. We're buying stocks because the market's down, and it is selling stocks because it's saying you're 1 year closer to retirement. So that's my issue with target date funds. The hard part of our job is when we give examples like that, I try to be fair to the other side. And yes, this doesn't happen every day of the week, but corrections of a 10% drop, they do happen about every 14 months.
Right.
So this doesn't happen 365 days of the year, but it happens about every year and a half. There's volatility, and these little things, if you eke out an extra, 1% more in return or a little bit less in taxes, does that add up? Of course, yeah, it adds up big time.
Okay, and so what about the stocks and ETFs?
So we the way we invest our portfolios, typically clients have, depending on how much money they have, what model they're in, most of our clients are going to have roughly 2/3 of their money in individual stocks, and a third, maybe a half of their money in ETFs, right? ETFs, the benefit, it's like a mutual fund in that it's a basket of stocks or bonds or whatever the case may be, but it's fully liquid while the stock market's open. The fees tend to be significantly less inside. You typically on an ETF don't pay taxes unless you sell that ETF and you made money. Let that sink in. That sounds obvious, right? You don't pay taxes unless you make money.
Unlike what could happen in the mutual fund.
Exactly. So ETFs I like because it's an awesome way to buy, a certain sector. Okay, energy is attractive right now, or financials a few years ago we did that. It's a quick, easy way you can buy an ETF that has the top 20 banks out there.
But it buys instantaneously.
Correct.
And I know I can, and so could you. I could name specific dates where we made a trade at 9 a.m. after the market opened that traded instantaneously. By the end of the day, the market had already moved 5-10%. If you're in a mutual fund, you could have called it right on the day, but it's not buying in until after that increase at the end of the market, so you missed all of it.
That's right.
Which is a huge deal. I don't think people realize that enough. So you're paying more for a mutual fund, but it's not as nimble. When the ETF, you can follow the same sector as you could in a mutual fund, but get more nimble at a lesser cost to you.
You're right. You're right. And then on individual stocks, depending on what model somebody's in, how conservative or aggressive, they may have a third of their money, maybe a little bit more, a little bit less of their money in individual stocks, which we like. And what this allows us to do is that point that you just gave is we can take a sniper approach and take advantage of. I gave the example of CrowdStrike. There's plenty of other examples. Hewlett-Packard Enterprise, not to be confused with Hewlett-Packard, right? Hewlett-Packard Enterprise was spun off by Hewlett-Packard, and they do semiconductors, not like NVIDIA does. NVIDIA does semiconductors for AI and soon-to-be, or not soon-to-be, it's already happened, robots.
Can't wait to get mine.
Have an assistant
I just
robot.
want a friend at the house that I can talk to.
The Hewlett-Packard Enterprise does a semiconductor to keep things from overheating, whether it's your phone, whether it's your refrigerator, any electrical device in your kitchen, really. And that was a stock that got hurt earlier this year, and we could take a sniper approach and invest just in it. Had we invested in an ETF in, say, semiconductors, that would have been a small piece of it, but now I'm buying semiconductors that the price is not attractive. So that's what I love about individual stocks is I can cherry pick the good, and I don't have to have the stocks that are overpriced or I don't find attractive at this moment. And last thing I like about individual stocks is you can do a ton of tax loss harvesting, right? If you're in a mutual fund or in an ETF, it's rare to do tax loss harvesting. Tax loss harvesting, what does that mean? That means you invest in something, and you could theoretically do this in an ETF or stock. You invest in a stock, you obviously bought it thinking it's going to go up, but you were wrong. It went down 20%, but you still like the stock, right? It just maybe it missed its earnings, or like CrowdStrike, something happened. It's not going to affect it to go bankrupt, but it's made it, it's changed the valuation, and it's made it a lot more attractive. You could further buy more of that stock. Now you wait 30 days and you sell your initial cost basis. What's the point of that? I get to deduct that on my taxes. So a quick example, I buy 100 shares of CrowdStrike at say $100. It goes down to $70. I buy another 100 shares at $70, right? The current price.
Drop the cost basis.
Drop the cost basis,
Right.
Wait 30 days. Now I sell my original one and I get to deduct it. I bought it at 100, and whatever I sold it at, say it's at 85, I got to deduct $15 per share.
Now, can you hold it long? You can hold it longer than 30 days, right? 'Cause
Correct.
if it's on a run back up, maybe you hold it 45 or 60 days.
Absolutely.
Especially to your point, if it went from 70 to 85,
Yep.
and you cut your cost basis in half, now you're profitable. If we think it's going to continue to go up, you could also hold it and then sell off on it.
We did that with Estee Lauder not too long ago. So there's plenty of reasons or strategies of how long you could take it, hold it. Minimum
Minimum
30 days.
yeah.
If you don't do it, if you're asleep at the wheel, or your advisor is, how often have we seen client statements and we look at their statement and it says wash sale. A wash sale means the advisor, for whatever reason, they acquired more of that stock that was down, and within 30 days, they sold it. Now you don't get to write that off on your taxes.
Mm-hmm. You actually brought up a really good point. You know, this doesn't happen often, but many people think that not having all their eggs in one basket is having multiple advisors, when that's really not the case. It's being diversified amongst investments in the stock market.
Exactly.
If you have multiple advisors, and again, it's a small percent of the population, you could have a wash sell rule by the right hand not knowing what the left hand is doing. So one advisor's selling something, the other advisor's buying something, and they do it within that 30 days. And now you're getting hit with tax when one person thinks they're helping you, the other person thinks they're helping you. The realization is you're actually being hurt.
You're right. So quick example. Let's say I'm a client and I have two financial advisors. And they both own Coca-Cola. Coca-Cola goes down, the stock. And the first one says it's going to go down further, I'm going to get out. They sell it
to give you the loss.
To give you a tax loss. The other advisor, they believe that this is an opportunity. They buy within those 30 days. They buy Coca-Cola. So now,
doing what you just talked about to get more on the way back up and lower that cost basis.
Exactly. And we'll know in a year who was right.
That's right.
But that's irrelevant for the purpose of this example. The point is, by the second advisor buying Coca-Cola, you don't get to write that off on your taxes. That's called a wash sale rule.
Right.
You know? And also, in addition, you brought up a good point. Sometimes people think it means being diversified, having multiple advisors. Yeah, sometimes that happens, and that's not one of the questions we're going to discuss today, but now let's talk about it. Yeah. So sometimes when somebody says, hey, I have two advisors, I don't want to have all my eggs in one basket, that's not what that means, to your point. I would say you want one advisor. And sometimes when it happens to us, I tell them, look, okay, we can try this. Let's try this working together for a year or 18 months, but I'll only do it if you promise me in 18 months you're going to fire us or you're going to fire them, based on whatever the agreement is. It could be, are we focused on performance? Are we focused on the plan, on the estate plan to make sure it's done right, whatever the case may be. But because I think it's going to do the client a disservice, right? Why? If you have two advisors, your fees are going to be probably higher because you have less assets at those firms. You could have a wash sale going on. And then I would say most people pick a financial advisor for a lot of reasons, right? They think they're going to help them make money. They're going to help them perhaps get their estate plan lined up with their attorney, make sure they're maximizing their tax losses when it comes to investments. There's a lot of things, but I think one that often is overlooked, if you're maybe an outside looking in, that I can see being a financial advisor, I think something that people really value is time back in their life. We have several financial advisors who are retired, who use us now today. And I use that as an example because theoretically they have enough knowledge. They could manage their own money. Why do they use us? They use us for time back in their life. They don't want to spend 5, 10, 15 hours, whatever the case may be, managing their own money. So to that end, if I have two financial advisors at two different firms, who is now quarterbacking both of them? And I would argue it's you, the client. Because what happens if one has a strategy? We think interest rates are going to go down. Fed Chairman Powell later this year is going to lower interest rates by 100 basis points. One financial advisor thinks that. And so because they think that, they're going to put you in long-term bonds. The other one says, no, we're not going to lower rates because inflation is coming back up due to the tariffs. Rates are going to stay elevated, so therefore let's own short-term bonds. You have like two different strategies going on. That's like you're playing a football game and you have two head coaches yelling plays at the same time. That's just, you're making it harder on yourself. You, the client, you're going to have to determine whose voice to hear. So I think you're creating more work for yourself. You're hurting the financial advisors. I think you're going to make it hard for either of them to do a great job. So that's why typically, I don't know, off the top of my head, I would say maybe 2-3% of our clients have two advisors, and even those we encourage them, look, if you think the other one's doing better, they're making you more money than we're going to make you, better service, better cost, then use them. That's fine. But pick one. You're doing yourself a disservice and your family a disservice.
And learn their process. Learn what meshes better with your philosophy and have a financial plan, things like that. Yeah. All right, so thank you for answering all of those questions for us. Last question before we jump into it. What is the process to begin working with GDS Wealth Management? What's kind of that little sizzle?
Well, as you know, we call it the GDS experience. Right. And it starts with a phone call. Do you want to? There's several steps. Do you want to start with the first step, number one? Phone call?
Absolutely. I love this part because I think the way we do things is we kind of pride ourselves on not telling somebody what they want to hear to gain them as a client. So we created the GDS experience to have this process so people can learn us, we can learn them. And it starts with that initial phone call to make sure that we're a good fit. And so the initial phone call is a 10, 15-minute call, us learning about them, kind of what their needs are, them learning about us a little bit, really just trying to find out if we're an initial fit. Not getting too granular, just kind of high-level stuff. So once we realize that and we feel like they're a good fit and they're nice and we can get along, then, of course, we'll set up the first appointment. So you want to do that one?
Sure. First appointment, it can be here at our office in Flower Mound or a Zoom. What we're trying to really do is dive into your goals, what's important to you, things, if you have an advisor, things that you feel like they're dropping a ball. We're trying to get to know you, things that are working well, things that are working poorly, and set the stage.
Yeah,
right?
Kind of why they're looking around in the first place.
Exactly. Because I would say most of the people we work with, they already have an advisor.
Right.
But there's an issue. They're not being communicated. Something's being missed. So what we're going to try to dive into is what their time horizon is, what their goals are, what their risk tolerance is. From a high level, we're going to give them homework, which maybe I'll pass that back to you and you can talk about the second meeting. But in the first meeting, it takes 45 minutes to an hour. Really depends on how many questions our clients give us. But we're trying to dive into what their goals are and what they're trying to accomplish. Of course, the obvious ones, do they have any estate planning done? Do they have a financial plan? Are they working with a CPA? What are they doing to maximize their tax deductions? Stuff from a high level. We're not trying to prescribe anything, if you will. We're just trying to get a feeling of where they're at right then. And then that tees us up for our second meeting, which in essence is our MRI. But before the second meeting, we have a phone call. Do you want to dive into that?
Right. So once we give people that homework, which is the financial plan, and I love going back to the financial plan. I know we talk about it a lot because more than 80% of advisors don't build financial plans, and some that do charge for it. So we put our best foot forward, and we give them a very comprehensive financial plan up front. So we give them that homework. Once they have the questionnaires complete and they get them back to us, one, we let them know, hey, thank you, we got them back. But then we ask for 2 or 3 business days to build the rough copy of the financial plan. Go over commonly missed shortfalls. Nobody fills them out right the first time. We've been building financial plans for 20 years. So it's our job as a fiduciary to catch anything that they might have missed, any potholes along the way. So about 2 to 3 days after we get it and we build it, we give them a call. Go over those commonly missed shortfalls, make sure it's accurate, and then we set the second meeting. And of course, the second meeting where we're at right now that's when they come in. We present the results of the financial plan.
The MRI.
The MRI. The strategies that we have learned are important to them because there is not a one-size-fits-all. You can't have a cookie-cutter model for everybody that walks in the door. So it's got to be personalized, and you've got to go through those things that most people aren't thinking of. You know, we talked in an episode of the podcast about how 100% of advisors invest money, and that's how they get paid. We're no different. We invest money, and that's how we get paid. But it's only 60% of what we do. The other 40% is answered in the podcast, where we're answering questions like when we talk about the strategies of the financial plan, it's answered with questions like estate and legacy planning, how and when to take Social Security, healthcare, biggest expense in retirement people aren't prepared for, Roth conversions, all of these things. So when we come in the second meeting, we're presenting those results and strategies we've learned are of value. Then we're going to go over the investments because there's no one size fits all. We have 19 different investment models. We go over fees down to the penny, our service model, you name it. And at that point, if somebody likes it, wants to become a client, perfect. We'd love to work with them. But if not, no harm, no foul. We're not mad at them.
Thank you.
Yeah.
That's a great job explaining step number 2. Step number 3 is, to your point, if the potential client wants to be a client at that point, we onboard them. We will have answered all their questions in terms of our service model, in terms of any costs involved, how we take care of bringing over the assets in kind. In kind is industry lingo, meaning you don't have to sell what you have. It comes over just like it is. If you own 100 shares of Coca-Cola somewhere, 100 shares of Coca-Cola, just move over here. Our service model is once somebody's a client, twice a year. We're going to want to do preferably in person, but we have a ton of clients in Florida, California, and other states. We do those over Zoom, not a problem at all. Twice a year, our preference is to go over the financial plan that we just spoke about. It's to go over the investments. Are we making money? Are we losing money? Why? Is inflation less or more than we thought it was going to be? And inflation, we've talked about that many episodes previously. Inflation is different for everything, right? Different for health insurance than a retirement home, than other things, aspects of your life. We look at all that. Twice a year, we're going to do that financial plan and the investments. In addition to that, we're going to call you typically 2 to 4 times a year. That's what we say. The reality is most of our clients hear from us significantly more than that.
That's the minimum.
That's
guarantee.
the minimum that we offer.
And that's regardless of asset level.
Correct.
Yeah.
Yep. As long as there are our minimum, obviously our minimum here is $1 million for us to work with somebody. And it doesn't matter. So if they have 1 million or 100 million, we're doing that for everybody.
Awesome.
2 to 4 phone calls, or could be Zooms, and then a client can call us as much as we want. We're not like an attorney that's going to bill by the 15-minute increment.
Right.
And then, of course, we have our events that all clients are welcome to attend. In the past, as you know, we've had Rob O'Neill, the gentleman that killed Osama bin Laden, speak to our clients.
Fun event.
It was a fun event. We've had famous musicians speak and play music, singer-songwriters at, we did Rangers Stadium. Was it this year?
This year,
2025?
February, I think.
Oh, February, March, yeah. I think February, you're right.
Fancy, I still listen to it in the car and buy dirt. It's like every morning. It's like a routine on the way to the office to get me ready for the morning. Yeah.
Great songs. They're great songs. And then we do webinars too that people are welcome to attend. We had a gentleman who they made a movie of his life, who was a spy. Man, do you remember his name too? I'm drawing a blank.
Robert. Good. Eric O'Neill.
Eric O'Neill.
Yeah.
You're right. And there's a movie of him.
Breach with Ryan
called
Phillippe.
Breach. You're right. Yep.
Yeah. That's a good movie. That's 20 plus years old though.
Yeah, and he did a webinar telling the true story of how he caught the spy.
Mm-hmm. And it's funny that even though he's been through all of that, people still try to hack him in his own personal life, and he's the guy who brought down so many people. It's crazy.
And then we have a webinar later this year. We have Gary Chapman, the gentleman who wrote the 5 Love Languages. That
every wife's favorite book out there.
Exactly. Hopefully
today.
you read it now and you apply it.
Well, I don't read, but I listen to it. Yeah,
I'll read it to you.
But my wife
just
wants
copy
me
my
to.
example.
She knows my love language.
What's that? Words of affirmation.
Words of affirmation, probably. Yeah.
So yeah, that's the experience, right?
Yeah.
GDS experience. The initial call, the discovery meeting, review customized plan. You become a client. Then we're doing our 2 to 4 phone calls. You're welcome to attend as many events or as few as you want. Some clients never attend any event. They say, "Hey, I love you guys, but the 2 meetings a year is plenty." Others come to every single thing we do. And we're fine with whatever you, the client, wants.
They can be as much of a part of this family as they want to, or they could be the distant relative that loves us but just says, they're a little too crazy for me at the event.
That's right. That's right.
Perfect. All right. So anything else you want to add?
Nope. You
All
ready
right.
to do mailbag?
I'm ready to do mailbag.
Today?
Let's see. This is from Katie. It says, what is the most common mistake that you see people make that you immediately jump in and go, without giving away the secret sauce,
Sure.
I've got to fix this. I've got to help this individual or this family. What would you say that would be?
Man, there's so many things I can think of, but I think the first one that jumps out that's the most common is lack of a financial plan. Mm-hmm. As you know, when we hire financial advisors to work here, sometimes they'll ask the client, they'll say, do you have a financial plan? Mm-hmm. And you've heard me talk to them. I said, that's not the right question. You don't ask them if they have a financial plan. Because if you ask somebody out there, do you have a financial plan? 100% of them will say yes, right? The question is, when is the last time you updated a financial plan? And then the question is, oh, I have a plan, but I updated it 4 years ago, 3 years ago, a couple years ago. Rarely is it, I updated it 3 months ago, 6 months ago.
And we're basically saying a financial plan at this point because we don't know. It could be your basic Google calculator.
Exactly.
It's not getting any of the nuances.
So I'm not even saying, is it like a world-class financial plan?
Right.
I'm just saying, do you have a financial?
And in their mind,
I'm saying it wrong. Not if you have one. When is the last time you updated a financial plan?
And they might just think, yeah, I do, but yeah, it's the basic Google calculator one.
Yeah, and that one they looked at 18 months ago.
Right.
Right.
So there's basically nothing.
Yes.
Yeah.
Yes, if you call them out on it.
Yeah.
And I think that's the biggest thing, because what's that saying? If you fail to plan, you plan to fail. Mm-hmm. You have to have some type of plan. And sometimes people will say, yeah, Glenn, but you can't predict what the rate of return over the next 30 years is going to be, what inflation is going to be, what my expenses. Okay, we won't predict it exactly, but I can tell you we will be in the ballpark. Mm-hmm. I would rather be in the ballpark of how much money I need to retire, what I'm going to leave behind, than not even in the ballpark. You have no idea if you're ever going to run out of money. Maybe you should be spending more money right now. You have plenty of money. Maybe you should be giving more to charity, more to your kids, whatever the case may be. Or maybe you should be pulling back, because that's going to ensure that you have a lifestyle for your whole life that you're comfortable with. But if you do a financial plan and you're constantly updating it, you're going to bring the future into the present. And just like an MRI or a CAT scan, I know you love to do all these. I don't know how frequently you're supposed to do them. MRI, I think, gives you like radiation, right?
No, CAT scan's radiation.
CAT scan.
MRI is not radiation.
Okay.
You can go get one of those every 6 months if you want.
So that point, that goes along with a financial plan about every 6 months. Why? Because you want to catch something. What you don't want is, it's been 4 or 5 years since you did the CAT scan or MRI or the financial plan, and now, I got to live on 30% less money for the rest of my life because I spent 10% too much previously, and some of that I could have controlled, right? Now you have to make huge sacrifices, whereas if you would have caught that 4 or 5 years ago, you would have made relatively minor financial sacrifices.
And it goes back to that early detection, just like the MRI is key.
That's right.
And somebody says, you don't know what it's going to be in the future. You don't know this. You're right. I don't know what it will be in 10 years, but if we're monitoring it twice a year at minimum, then we're able to tweak. Financial plans have to be nimble. They have to be that vehicle that can always be changed, because life happens, life changes. So yeah, I agree 100%.
Awesome.
Good. Well, thank you for answering that. And I want to thank our audience. Remember to keep sending in those questions, and you can always mail them to gds@gdswealth.com or comment on any of the channels that we're posting on. Thank you for attending.